Please welcome your panelists for How Will Technology Trends Impact Your Portfolio, moderated by business editor at Axios, Dan Primack.
Hello, everybody. Thank you for coming. I'm glad. I guess this is the group that's not concerned about war with North Korea. So good for all of you. Thank you for being here. So we're going to discuss kind of how technology is impacting portfolio construction, how it's impacting investment firms, how you guys are thinking about technology in your jobs. I'm actually going to let you guys introduce yourself. You have to do it extremely briefly, and I want to know your name, where you work, and what your first job ever was. I'll start down here with you.
Jeff Schumacher, founder of BCG Digital Ventures, a unique venture capital firm. First job, mowing lawns.
Mowing lawns? That's good.
Nicole Musicco from Ontario Teachers. First job was gym teacher, gymnastics coach.
I'm Morris Mark. I'm CEO, founder, and president of Mark Asset Management. And my first job was delivering flowers at $0.25 a shot.
Dan Primack, business editor of Axios. Let's see, first paying job was DJ at a radio station.
Hi, my name's Colin Le Duc. I'm one of the co-founders of Generation Investment Management. My first job was my dad made me work in a factory in the northeast of England over the Easter holidays, making ammunition boxes for the military, which made me want to work really hard at school.
Hi, Jason Greenberg. I run the technology advisory practice at Jefferies. My first job was collecting range balls at a golf course, which definitely made me want to continue my education and not do that anymore.
Right.
Fair enough. Fair enough. Nicole, let me start with you. So
Sure.
You run the public equities portfolio for Ontario teachers. Huge portfolio, diversified. I'm curious, do you believe, when you think about technology, is it your feeling that you guys view it as something that impacts every piece of the portfolio, so it's just figuring out how each of the pieces are impacted, or do you view technology kind of as a standalone sector for you guys?
I would say even to step back even further from that, we're viewing technology right now through three separate lenses, really. We're looking at it certainly through our investing lens, but also through our risk mitigation lens, the impact that tech could have on any of our portfolio companies, as well as just through an enablement lens, i.e. as an asset manager, are we investing in and preparing ourselves, for investing behind the technology that is coming into play to make us strong asset managers. So we cover technology in a number of the asset classes, and I think over the last, call it 5 or so years, we've really tried to look through all three of those lenses across the different asset classes.
Morris, you've made the argument, and correct me if I'm wrong, that technology isn't a sector anymore. Is that the way you view this?
Well, I'd say the technology production obviously still is a sector. So businesses that produce, let's say, digital technology or produce the software that's used for it, that's a sector. But secondly, today, because of the rapid growth of everything that digital technology represents, it's in almost every sector of the economy. You can't look at telecom as a sector. You can look at companies in telecom that are benefiting from digital technology disruption or others that are much more challenged. You can obviously say the same thing about retailing, or what we call direct consumer merchandising, but it cuts across, at this point, just about every traditional sector. And I think it's critical to understand that.
And you've been investing in technology since the 80s, correct?
That's right. We bought Microsoft in '87, about 6 months after it went public. Dan and I were talking about it. I had a really good salesman who said that DOS was going to be in every IBM-compatible computer. And I didn't know much about DOS then, but I did know that sounded an awful lot like Coca-Cola syrup. So we stayed invested. It was much more challenging than that. But we stayed invested in Microsoft until 2000, and then we bought it back again in 2014, and we're still invested in it, and we really like it.
So bought back right when Satya took over.
Excuse me?
So bought back right when Satya took over.
Exactly. He was endorsed by Bill Gates, and I thought that was a strong endorsement.
What happened to the salesman? Is he still with you guys?
No, he's not my salesman. He's the salesman of the brokerage firm. I lost track of him a long time ago. He was a great guy.
Fair enough, fair enough. Jason, you're at Jefferies, and you run for tech banking and tech. So you're not somebody who's got a portfolio per se, but you're advising companies. I wonder, within your bank, are you viewed kind of, and not you, but you and your group, kind of as the gurus that all the other groups go to figure out? I guess tech banking seems like a kind of interesting thing right now, given that all the other sectors, the industrial bankers, the retail bankers, et cetera, are all being impacted by the companies you're working with.
Yeah, so I've been doing tech banking for 25 years, and until about 10 years ago, technology truly was an isolated segment. Sometimes folks would do it within the construct of media and telecom, but it really was its own group. You saw the vast preponderance of companies that were buying technology companies were within technology, and most technology companies were selling horizontal solutions, not verticalized. So while they impacted different industries, you weren't finding yourself having to go and talk to a GE or a Honeywell or a Roper or a Audi, et cetera. You weren't having to go outside of industries. And I'd say within the last 10 years, two interesting transitions have happened. Number one is about 2 years ago, the majority of technology deals that are happening are now being acquired by non-technology buyers, by both private equity, which accounted last year for around 25 to 30% of deals in technology, and another 30 to 35% were non-technology buyers. The Walmarts of the world buying Jet.com, the GM buying Cruise. Every industry is being impacted both through the disintermediation of folks in the supply chain that used to exist, number one, and then number two, you're seeing the impact of technology on fundamental business models. So we're beginning more and more to collaborate with our partners across different industry groups because they have the relationships oftentimes with a large real estate firm, for example, or a large automaker. And I think the trends that are happening within vertical technology companies are impacting each business. And if companies don't change, they will go out of business. And you're seeing it first now in retail. If you look at effectively what's happening across malls across America, you're going to see it in the transportation ecosystem. You're seeing it in real estate. We can go through every single vertical and talk about different trends that are impacting, and I think that will only accelerate.
I'm curious, so of those three segments of buyers, traditional technology companies, non-traditional buyers, so non-technology companies and private equity, please rank from smartest to dumbest when it comes to buying technology companies, generically.
I would say the most cynical are technology buyers because they have the longest experience at seeing what does and what does not work. I think that industry buyers right now don't have the breadth or length of experience to know what will or won't work within their companies. And finally, I think private equity has been and continues to be very sharp buyers of companies. I think their landscape is changing given the amount of money that's been flowing into private equity and the challenges. But I would say, and it was actually an interesting takeaway, I don't know how many folks saw a few years ago as part of one of the security leaks that hit Salesforce, Colin Powell's emails were basically published. And one of the things that was interesting was Salesforce.com was talking about and looking at ranking its acquisition targets within the industries. And the number 1 and 2 rankings they had effectively were Glassdoor reviews of what's the actual culture. And I think that's one of the things that really is probably the biggest disconnect between industry buyers and tech buyers or tech targets is, for everyone who's spent any time in Northern California and has seen the average technology company, imagine putting that into a industrial conglomerate based in Germany. The cultures don't match very well.
That's interesting. Right. Colin, you guys focus, your big focus, and correct me if I'm wrong on this, generation is sustainability. That's kind of the headline, and a bunch of people probably saw your partner Al Gore speak yesterday. When you think of your portfolio...
I'm usually his warm-up act, but he very kindly
he
just set the stage for us yesterday.
That's very nice. That's kind of him.
Yeah,
that's good.
It was very nice of him, yeah.
How do you kind of view technology working inside of your portfolio? In other words, is it similar that it's now kind of immersed in every piece of it? Do you actually view technology as a thing? Or is that just simply kind of par for the course? It's just kind of part of everything you guys do now?
Yeah, I mean, look, our worldview at Generation has always been that sustainability is an imperative and is driving, very deep secular change in the whole economy. And, that's presenting a whole series of kind of risks and opportunities. And in particular around the opportunity set, we focus very much around sustainable technology, products and services that are really helping lead the transition to a sustainable economy. And in that regard, we'll focus on very deep transitions around mobility or energy or food or cities or whatever you care to mention. We're also very focused on the fact that technology in and of itself is not, the sole kind of driver of a lot of this transition to a sustainable economy. There's consumer awareness, there's regulation, there's reality, and these kind of things that are also driving a lot of adoption. So I would say that technology for us is really just kind of embedded in everything we're looking at in terms of the solution set around.
So you guys are a growth equity investor in reality is one of the things?
Yeah, I would say so.
That's novel.
Yeah.
That's fascinating. Reality. Jeff, and then we'll kind of have this become more of a conversation, but I think I want to ask for you, and I'm going to ask everybody on the panel, but I want to start with you on this, which is if we think back, you don't have to have been at this conference last year, but if you think back to this time last year, I'm trying to kind of get a sense from all of you on what you think has been the main kind of technology trend that has affected you or has affected your business or affected your portfolio construction the most that you might not have been thinking about as strongly last year. Jeff, I think I know what your answer is. Can you talk to me a bit about what you see as the most important technology right now that's affecting not just that you're looking at, that's kind of impacting where you think you'll be doing for the next infinite years?
Well, we're a really early stage firm, right? So we look at things that are going to go from paper to market within 12 months and to scale within 36, or we fail it. And we look at a lot of deals. We're global, so we see between 300 and 1,000 deals a month. So it's pretty significant of our deal flow. I would say the most significant technology that we see, that I've seen in the last 20 years, is what some people call the blockchain.
What do you call it? Can you? What does blockchain? I can't believe I'm asking. What does blockchain mean to you?
I think what we would say is it's the idea of decentralized technology, and we've been focused a lot around the protocols, not the silliness around ICOs and the next Bitcoin valuation, which is more of a speculation vehicle.
You're not buying the Oscar Mayer bacon coin?
Not lately.
Okay.
So
it's available.
Sure it is. So we've been really focused on that, and when you get into decentralized, you can start getting into very interesting things where we're not very interested in two-sided marketplaces. Seems like a lot of companies are two-sided marketplaces these days. And all of these companies that are intermediaries, create all the problems that you see. Data gets hacked, security, privacy. Concerns are when you centralize and you put somebody in between you and that transaction you're trying to do. So we were very focused on that decentralized idea. And then when you get to that, you can get to things that we've been talking about around food provenance. You can track food. We've got a platform where we're tracking diamonds from the ground to the finger, which gets rid of blood diamonds. We've got a platform under development around fake news, elimination of fake news, and those things. So I would say, without a doubt, if you consider probably the most important technologies in the last couple of centuries, one would be electricity, two would be what we're seeing today around decentralized.
I'm wondering though, from an investment standpoint, when you talk about investing in so not investing in a cryptocurrency that becomes a commodity and has value that goes up or down. When you're talking about investing kind of in a protocol, can you walk me through that a little bit, how that works from an investment standpoint? Because it would seem when you're talking about decentralized technologies, it's the centralization or the intermediaries that people often invest in because there are walls there. There is not something that somebody else can easily improve upon.
Well, if you think about what we're doing by removing the intermediaries, that value's got to go somewhere. So if I talk about...
But it's one thing to go into another bucket as opposed to kind of going into an ocean.
It goes into an ocean, which is the foundation of that would be the token or the gas, right? And that value will go there, as well as that value will get distributed to the users of it. So you can talk about a decentralized Facebook. You can talk about a decentralized Uber. You can talk about a decentralized Airbnb. You can just talk about a decentralized payment platform, a decentralized bank. All of these things, that value has to go somewhere. I believe that value will go back to the users where it should be. That's what technology was there for, right? It wasn't there to make individuals rich. It was there to actually democratize societies and make societies better. I would argue largely technology hasn't done that. And I think that's the opportunity we have here in this decentralized world. And we've been focused a lot around the third protocols in what is called the blockchain, which solves a lot of the issues that you've seen in the first two protocols, which are around power consumption and around performance, and then around proof of concepts.
And talk to me about the third protocol. You guys are coming out with something, correct?
Yeah, we're spinning out a foundry that's going to sit on top of the third protocol. One that was probably the most interested that we've seen is Definity. I think Andreessen put some money into that lately. But our foundry is called Devolution. I think our founder is sitting somewhere in the audience here. That one is going to have about 15 in its portfolio coming out of the chute, and that'll be pretty exciting what they're doing.
Morris, for you, you guys are invested in a lot of the big two-sided platforms that he was just talking about.
Right.
Are you concerned that pick a number of years, doesn't really matter, that your portfolio is about to be disintermediated, essentially?
Not yet, because there's a need for authentication. I think you can use a blockchain to create an infinite number of coins. It's just as many as you want. And there's nothing to prevent, and in fact, you would think maybe Visa or Alibaba, Alipay, will just say, okay, you sign up, we give you a coin, you know that if you use it and it's inside our blockchain, you will be paid, your product will be delivered, you have immediate response. So I think that what the companies that provide these functions today do is that part of it is authentication. Part of it is the fact that they help you do something. How do you know? One of the things blockchain can say is, okay, you deserve to be here, and you don't. And if you have the coin, you deserve to be here, so you can make use of all these services. The fact that somebody said, let's say you bought a Bitcoin. Well, how do I know I bought it? How do I know, even if the value is changing, that it is what it is? I have to have something with credibility behind it. So these are probably the best businesses in the world to provide that credibility to the extent that they can set up the chain.
And I think that's a little bit of the second protocol. The third protocol says, hey, I don't even need that. So the third protocol says I can truly democratize everything. Second protocol is you argue with these private chains and who gets to participate in them. Third protocol says I can do open and private at the same time. This is the thing I get most excited. I agree with you in the second, and the coins and the issues that come with that. But in the third protocol, where you can say, I know you are you, and I know identity, which we're working on, is one of the utilities. You crack identity, you democratize everything. Right. And now I can hang on a flagpole all of my data, and nobody can hack it. And once you do that, you hand the power back to the people, and that's the important part.
Well, I'm not sure that that's completely true, because 1, you need a device. 2, you need to know that it's going to work. 3, you need to know it's not going to shut off. 4, you need to know that if it does shut off, there is a place where everything that you have put in there resides and can give it back to you with a new device. And that new device has got to be compatible with that chain. So you're right, the process is going to be different. Mm-hmm. But I think that if Microsoft hasn't thought about this, I'd be shocked. Okay?
Nicole, let me ask.
Okay, I apologize.
No, you shouldn't apologize. Nicole, let me ask you a very complicated question, which is, who's right?
I'll add what we've been thinking a lot about,
Sure.
To move on the conversation a bit, is really just around data. We have over close to 100 companies that we control or have effective control on, and we sit on just mounds and mounds of data. And so it was really just a year ago when we started to get more organized and start leveraging partners along this panel, actually, to say, well, what can we do with this data, not only to make our existing portfolio companies faster, stronger, better, but maybe even evolve them into something new and new business models. And it's been amazing, just that exercise alone, which required us to get multiple asset classes in a room, starts to change the culture, it starts the conversation happening, and moving a big ship like a 200 billion asset management firm like Teachers is not easy, but this one opportunity or this one technology, to your point, has started that conversation at
Do you actually need technology? So it's one thing to have asset managers from different areas of the shop in the same room. Do you need actual teachers, and have you hired, do you have actual technologists, not investors, not people who really are capital markets experts, but people who could otherwise be working at Facebook or could be working at his foundry?
Yeah, we do. But I think, again, this has been such a fascinating year because we started to turn the stones, if you will, on their head, and we're finding we have these resources that are sitting in departments that we may not have thought to lean into, whether it's in diligence or even thinking about how our own infrastructure, whether it's competitive or not. And so the answer is yes, but I think what it also opened our minds to was we need to think about our talent acquisition model a lot differently. We need to be really thinking with a 10-year lens. Ron Mock was on a panel earlier today, touched on this because he's our CEO, because it's just such an important fundamental piece of this puzzle. If wearing our long-term patient capital lens. If we don't have the talent, and if we don't figure out how to attract and retain them, then all this great work and energy that we're putting into thinking about what is our tech strategy is really for naught.
Colin, can you explain, how do you, from a sustainability lens, view, just to stick on blockchain for a second, how do you view blockchain as its importance to you guys, and how are you thinking about it in terms of investing going forward, how it impacts you guys?
We're still trying to work it out, to be honest. I mean, we haven't placed any bets in it yet. I mean, I think obviously the energy intensity of blockchain is of interest to us. But we're also quite interested in kind of new types of business model it can enable. I'd like to come back to the question you asked earlier, which was, what is the kind of most interesting technology trend that we've seen? I wanted to just mention what's happening in batteries and energy storage in particular. Al Gore talked a lot about some of the kind of cost curves. And what's that sort of enabling, and what is driving that is quite interesting. I mean, there are three very large industries that are very interested in battery technology. So that's obviously kind of mobile phones and computers and stuff like that. It's obviously the energy industry itself, and it's also the mobility space. And so you've got three massive industries all driving adoption of this technology, and it's that kind of cycle of adoption and innovation is just getting better. So that cost curve is going to just go one way. And we've expressed that through a couple of companies in our portfolio, and just a couple of others that are interesting just to mention. But we have focused a lot on the electrification of personal mobility, really by expressing that through other areas apart from just the next Tesla.
What do you mean by the electrification of personal mobility? Is that electric cars? Is that what you mean?
So I'm going to come to that. Okay. So think about there's a company that we're invested in called Gogoro, which is in Taiwan, which is actually an electric scooter business, but it has a battery swapping system behind it. So it uses...
Are they hated in Taiwan like Bird is hated in San Francisco?
Not at all. They're actually... No, I'm talking about two-wheel proper motorbike scooters, not the ones in San Francisco.
Fair enough.
Yeah. We'll probably be regulated out of business, but that's another question. But you can basically drive up to a battery ATM, essentially, and swap the energy cells that are in the scooter within 6 seconds and drive off. Another company that we're focused on is Proterra, which is in Burlingame here, which is a 100% electric bus, which is really interesting because they've shown that we're not just seeing cost down curves in things like batteries, but we're actually seeing massive performance improvements through electrification of mobility. So they just broke the world record in a single charge of a battery powered bus, which is 1,200 miles on a single charge. Which is pretty astounding. We've also started to look at other areas. Earlier this week, actually on Monday, was the next week is the Uber Elevate conference, which is
the flying taxi conference.
Flying taxi conference. So that flying taxis are coming. We've seen a whole number of different business models being presented to us. One that was interesting, there was this guy who's going around buying roof space in major metropolitan areas so that you can go and land your flying taxis on there. The other one is kind of electrification of planes. Electric planes are coming as well. What's beautiful about
that seems further off, though.
Yeah, it is a little bit further off, but
I can't get my iPhone battery to stay charged. That seems dicey.
It'll be short haul. It'll be very very short kind of city to city hops. Obviously, with electric planes, you can land much closer to city centers because there's no noise. You can also vertically take off in a completely different way to normal planes. So it's going to, I just want to mention that, people talk about electric mobility and they just think about Tesla, basically. But you've got to stretch your imagination to what these technology trends are actually enabling in other areas of mobility. So I think that's probably been a big theme for us in the last year.
I'm curious, does Tesla enables the wrong word, I don't mean from a tech perspective, but the incredible amount of interest and attention that goes to it, does that kind of ripple off to these other companies and help them, or is it a negative because it draws attention away from them?
I think Tesla basically helped stimulate an entire movement, I think it's fair to say. I was at an event a number of years ago where one of the BMW CEOs was saying, look, the reason we're moving into electric cars is, not because we're nice people at BMW, but because Tesla's eating our lunch in the luxury market in California. So, they stimulated a market, they stimulated a set of, what is possible. They also made electric vehicles cool, right? Which was, from a consumer preference perspective, really changed the game.
Yeah,
And
they
so-
only cost $100 because you can't actually get your car. So actually speaking, as you said, people only focus on Tesla. That is a bad thing to do, but we're going to do it for a second. Morris, you guys took a position in Tesla recently.
Right, very small amount of our money, 1/10 of 1% of our assets. You have some flexibility in a hedge fund to set something like that up, so your exposure is limited. And the reason we did is it seems to be far ahead of anybody else in developing vehicles that make full utilization of computing technology, electrical technology, and potentially autonomous technology. But it may not be a business. So we don't try to kid ourselves. If it works, this is probably the year when you will find out, because they have hundreds of thousands of reservations for a car called the Model 3. And it's a beautiful car. And on paper, and in fact, for those who've driven it, it's really fabulous. Can they mass produce it? Can they mass produce it at a gross margin which will generate cash flow? We'll find out. If they do, well, even though it has a very substantial market cap, the industry and the sector that they serve is absolutely huge. The support in government for pollution-free technology is only going to get better because we have a conservative government now, and that supports it. And if and when something like that changes, that only gets even more intensive. So the potential is enormous. We have a great deal of skepticism, and that's why we set up a hedge position. And you can do that with the hedge fund. Can't do it indefinitely, and you can't do it with every position, but you can do some of that.
Nicole, do you guys have Tesla?
I won't speak to it specifically, but what I will say
You
is
have a
doing,
company that makes electric cars.
what I will
with
say
a guy
is
who also
it's
makes flamethrowers?
by doing the work around Tesla, it's opened our eyes to playing the Tesla theme or the electric vehicle theme, autonomous theme across the entire supply chain. And so that's been very interesting for us, and not only within my department, the public department, but also within our infrastructure group, thinking about battery investments as well as within the private capital team. So it's been good to dig in and explore different ways to play the thematic.
I was just going to say there's another significant company that has really taken a significant lead in design of electrically powered autonomous vehicles, and that's a company called Waymo, which is wholly owned by another major corporation. So there's a lot of interesting stuff going on, and I think what Tesla did is it brought everybody aware of how strong the potential demand is in the actual consumer marketplace for these kinds of products.
Jeff, is this, and when I say that, electric cars, for example, is this one area where blockchain doesn't get to play and destroy?
I think it can play in it. We're definitely in the space. We have an e-scooter service that we launched in Berlin called Coupe. It's launched in Berlin and Paris, 2,000 scooters.
Now wait, scooters like his scooters, or scooters like Berg?
Actually, that Coupe service in Berlin uses the Gogoro technology.
Exactly.
So it's a joint venture between Gogoro and Bosch.
Very, very similar. That's why I brought that up. And then we also have an autonomous flying vehicle that we're launching with a company called Aurora that was just acquired with Boeing, and Uber Elevate showcased that last year. We'll be there this year with that. So we're big in that space. Autonomous and battery tech is there, and so we're doing a lot in there. And then I think blockchain can fit in there, and IoT. And
I'm on the Elevate thing. How close? So this conference. So I'm staying 2.5 miles away, and it took me about 40 minutes to get here today.
Yes.
Am I gonna, if I come to this conference in 5 years, am I going to have a flying taxi that's going to go over Wilshire?
I think you'll see it. I think you'll see it first in tourism. They got to get the things up in the air.
I'll be a tourist. They can tell me what's going on down below.
I think you'll see it in. We believe there'll be like exchanges, like very similar, like subway networks. It's not you fly anywhere. You fly to certain spots, points. I think you'll see the two-seater or the multi-seater is the ones that are going to win. This individual ones are more for show. There's no way they're going to get FAA clearance on those things. But 5 years is probably the window that you'll see a couple of cities get them. But it's going to be a while to get those FAA clearances.
Fair enough. Go back to kind of the original question, which is for you, and maybe it's already been answered up here, but the technology that really you think, particularly over the last year, has really taken maybe the biggest quantum leap in terms of how you're having to pay attention to it?
And maybe I'll switch it a little bit, though. I think the biggest leap in the last year that's affecting technology, to me, is regulatory flux. And I listen to all of this, and I agree with the concept of disintermediation of technology. I agree that technology is going to impact every part of our ecosystem, every industry. The biggest issue to me, whether it be from investing, whether it be from doing transactions, whether it be from predicting what's going to happen, is we have no idea right now what's happening in terms of regulation within industries. And you mentioned Bird as an example. What will the city of SF do with people leaving scooters on the
Just
corner?
hands. How many people know what Bird is? That's not bad. Go to San Francisco and you'll trip over one. Continue.
But start with that on a municipal level. Start with what's happened to Uber on a municipal level in terms of the technology outpacing regulation, which happens in every industry. But then go one step further and look at what's happening in actual international regulations and what's happening with trade. I have no concept. The one thing that the U.S. does better than any other country in the world, our single biggest advantage as a country, is technology. We literally dominate in technology, and it's probably the greatest advantage we have. Trade wars, personal opinion, don't help whatsoever extrapolate that advantage, given that technology has increasingly driven more value into the hands, I think, as you pointed out earlier, of the actual technology companies. Anything which limits the addressable markets or the ability to proliferate that technology across borders is value destructive to U.S. technology companies as a whole. And it's unpredictable. It's very difficult right now as someone who spends their life advising companies on how to either buy or sell businesses or themselves, what to do, because I can't predict for the life of me what's going to happen a month, a year, or 3 years in the future.
Could I just add to that? I think it's a really interesting point. And this notion of kind of what are the unintended consequences of technology applied at scale, I think is quite interesting, ranging from the effects of basically the Industrial Revolution and what's come out of that in terms of climate change and inequality and things like that. But equally, things like kind of social media at scale and the level of kind of alienation that's perpetuated in society as well. But I think I went to the WEF has just set up this Center for the Fourth Industrial Revolution in the Presidio in San Francisco, and I went there the other day to try and learn what they were up to, and it was very interesting because they're essentially an incubator for regulation to address the question that you're talking about. So you've got this incredible pace of innovation happening in terms of the core technologies and the business models to apply them. But you've got regulation that's miles behind and doesn't have the same type of pace of innovation to keep up with the real innovation that's happening. And that will just constrain the growth and will limit the growth if the regulation's not properly set. So I think it's a big topic.
That's interesting. It's interesting. I wonder, Jason, you talk about the regulatory environment, and, for example, particularly with what you're doing when it comes to M&A, and whether it be the AT&T Time Warner and stuff the DOJ has done, stuff that might be happening in China. I wonder, though, globally, M&A right now is up, like 29% over this time last year. It doesn't seem to be slowing people down.
It's hard to know what the right baseline is. We're very late in an economic cycle, which is typically M&A is a pro-cyclical business. There's more M&A at the top of the market than there is at the bottom of the market. How high we would be is hard to understand relative to what baseline. I can tell you as an M&A practitioner, getting deals done today is harder than it's been in a long time. To the extent you have anything that requires any form of antitrust approval in any jurisdiction, it's almost impossible now to be able to predict what's going to happen, whether it be with CFIUS in the US, MOFCOM in China, Investment Canada, what's happening in Moscow, what's happening in Germany. And if you look at companies as they increasingly globalize, the number of jurisdictions you have to get regulatory approval in has increased. That's at a high level. Then intra-US, if you look alone, as you were commenting on HSR approval for transactions, again, it's unknown. It's unknown because we have a regulatory environment and a government that hasn't had enough deals that have happened to be able to extrapolate. And secondly, it's reasonably volatile. In the past, it's been much easier to look at a legislature and/or presidency and be able to say, here's what the objectives are. Again, I would be lying to you if I told you I had a crystal ball as to what will happen.
Nicole, are there any industries, and so take get as either broad or as narrow as you want to get, that from your perspective aren't being significantly impacted by new technology, that you're, and I say that I guess in the sense of, to you, the industry looks relatively similar in terms of what they do day to day today as, say, it did 5 years ago?
I think we've almost looked at it through the opposite lens. We've kind of said, let's figure out how to mitigate risk in every single one of our verticals and sectors, because that is the challenge is the unknown. And so if I think even about our infrastructure book, which maybe a few years ago I'd think, gee, that really helps me sleep at night knowing it's nice, steady eddy cash flow. We're thinking constantly about, well, what does an electronic vehicle world look like when we own parking lots? Or what does, battery storage do to certain aspects of our portfolio? We own airports. How is that going to be? How is transportation in general? So it would be difficult. I mean, you could say industries maybe like tobacco, but that has its own issues, and we're not too big on tobacco right now. So
Fair enough. So invest in tobacco. Got it.
I don't think you want to avoid technology. I think what you have to understand that the pace of change is accelerating. I think I sort of paraphrasing a comment from the CEO of McDonald's, and he's a really bright guy. And by the way, McDonald's is a business that's benefiting from digital disruption because it's structuring itself to do that. And what he said was,
by getting rid of the kids who work behind the counter.
No, I think by having delivery, which is computerized and coordinated, by using the internet to get orders and putting mobile kiosks there, by making sure that they use technology so that what you eat is safe and standardized.
Of course it's safe. It's not real food.
Well, that's
easy.
Well, that's what they're talking about in terms of genomic engineering, which is digitally based in terms of the food supply. So you touched on it, but I think that everything is touched by it, and I think you want to basically realize that pace of change is accelerating. And if people don't manage their businesses with that thought in mind, they have a real challenge. There is one that we've thought of that we are invested in, which by its very nature is taking advantage of technology, but really hasn't changed that much, and that's building.
You mean construction?
Home building. Anything that takes a lot of wood, a lot of space, and a lot of labor. And there aren't building robots yet, So
they're coming, though.
that process.
It's coming.
That is changing.
They're coming.
I mean, there's plenty of kind of prefab stuff, and construction tech is, I think, advancing quite quickly, I would argue. But
Jeff, is there anything you think that's not that you feel you could invest in today? And I understand you're in the earlier stage, but if you were from an industry perspective and say, you know what, I don't have to pay too much attention to what's happening around it.
Well, I think we look again, I agree with the point, home building. You look at technology, it hasn't improved worker productivity.
Right.
It hasn't done it at all.
No.
Worker productivity is flat, if not down.
Yep.
So we're not seeing that lift that you would expect to see. So I think there are some insulated industries, at least for a while. And it could be, retail, it took a while for it to hit, right? The internet's been around since '96, and we're now finally seeing it. And there's things that come into that. So we look at, where we see the blockchain, it's where the internet was in '96, but look what happened in '99. So you'll see this thing. And I also agree that we're in this exponential growth period. Lots of corporations, and we work predominantly with them, see the world in a linear way. And that is a dangerous way to live your life, where you take 30 linear 1 meter steps, you go 30 meters. You take 31 meter exponential steps, you circumnavigate the Earth 26 times.
Right.
And that is the problem that most don't see it. They don't see that the growth we're going to see from this year to next year is more substantial than we saw from 2010 to 2015. And this substantial growth. And what we talk about is digital has the shelf life of milk. You need to move, and that's the key.
Actually, so let me actually ask this follow up on this, and maybe ask it from a slightly different way. I think I probably asked it poorly. Which is, so I was asking folks who are kind of investing in more mature companies, is there a place where they aren't concerned about something coming from up below? So let me ask for you, who's investing at the earlier stages, is there any area that when you see a startup, you think no, because the problem you're solving or the legacy industry you're trying to disrupt is going to be particularly difficult to disrupt? This is not the place to be putting your money at.
Well, I mean, Uber just proved that, right? Highly regulated, highly mature market. And people looked at Uber, and we have this word, we call it friction. We look for friction. If you don't have friction, you're a solution in search of a problem. And if you look at Uber, lots of people said, well, how much share are they going to take from a highly regulated market? Are they going to take 5% or 10%? And I think a lot of investors landed on 10. And they went around and they built out these models around what is the taxi service market and how much share they're going to take. Taxi service market in San Francisco 2014 was 140 million. By that model, Uber should have did 14 million in San Francisco. They did 520 million. Friction wasn't the taxi service, the friction was the car itself.
Yeah.
And this is where people are looking at industries from a tops-down model versus a bottoms-up. When you're early stage growth, you look bottoms up.
I mean,
And
ironically,
technology
maybe
technology subsumes greater markets. If you look, and it's a perfect point, there's geometric, not arithmetic growth. When you basically look out a year or two and extrapolate, which is human nature, you underestimate the size of markets. It tends to happen slower in the near term, much more in the long term. And secondly, if you look at predictions in almost any company that is successful in building a market, they underestimate the actual size, because what happens is they suck in adjacent markets, change their business model, and create a greater opportunity than you could have seen.
Yeah, and as to your point, Uber started out as a subscription service for black cars. They flipped their model, and that was the original business case.
I can't believe taxis in San Francisco are $140 million. I could never find one.
It's funny, we like financial services here because the banks have been really recapitalized. But the more we get into it, the more selective we are in picking names, because I think Mr. Corbat made a comment on Sunday talking about, if you're 90 years old, you want that branch. You have to have it. If you're 50 years old, it's nice to have it. And if you're 20 years old, you never want to go near it. All you need is, I'll show it to you, this, period. So when you take a look at some of the big banks, well, one of the 6 biggest banks in the world is Goldman Sachs. They have a product called Marcus now, where they can do consumer lending online. Other companies have tried it, but then you have the authentication, professionalism of an established institution that knows how to underwrite loans, and they just bought a business called Clarity and established a service called Marcus. No relation. I think that there's some really great opportunities and great issues in financial services by those businesses that can use technology to create a network and to create a wide range of customers.
All right, so let me flip all this around.
Could I just offer something up here? So I was just thinking about this as you're asking the question. I mean, ironically, it may even be the kind of Amazons and the Googles and the Apples, et cetera, who are the ones who are stifling quite a bit of the innovation. Because, I mean, if you've got somebody who turns up with you and says, I'm going to compete head-to-head with that, I mean, it's these natural monopolies, the FANGs, basically, that are so dominant in terms of their data moat, talent access, capital access, everything, that, you know, that they are now the incumbent monopoly.
Absolutely.
Right? And so this notion of regulation kind of having to kind of deconstruct some of that may be the kind of the initiator of more innovation that can actually compete with those companies. But if someone comes to us and says, we're going to compete head-to-head with Amazon...
Do you feel they're strong? Do you feel that those moats are stronger today than, say, on the media side, say that whether you want to say Disney or on the chip side, if you want to say Cisco, do you think the tech moats of today are deeper than the tech moats of, say, 15, 20 years ago?
Well, I think there's no doubt about that, because of the network effects fundamentally and the data moats. I mean, I think the biggest risk to those companies is loss of social license to operate primarily through regulation.
As well as access to capital. I mean, there was an interesting statistic I saw the other day that said that the top 7 global internet companies now spend more CapEx than all of the US cable and telephone carriers in terms of network builds. If you look at China, so China has a $50 billion fund, which is effectively trying to go after creating a semiconductor industry from scratch. It's the one area of technology they don't own. The biggest issue they've had is who can put $15 billion like Intel does into a plant if you don't actually know you're going to be able to produce chips in mass.
SoftBank, they can do it. They will do it.
Eventually, with enough money and enough time, you'll do anything. But the point I say in general is you look at a moat. Well, what's the moat on spending $20 billion a year on CapEx to be able to build global data centers, to be able to offer low latency, high compute, high storage environments? It's very difficult for any venture-funded company to be able to do that.
Right. We've been talking kind of about these technologies and the hyper-growth of them and how they're accelerating, not decelerating. So let me kind of flip this around and ask, and Jeff, I'll start with you, which is there something, say, in the past 10 years, a technology that you were convinced was, if not the next big thing, a next big thing, and you were wrong? It's not a thing.
We've been wrong a lot. That's where you learn from your things. So I've been wrong. I think that you answer that wrong question of why now. We're usually too early when we're wrong. We had a cloud services company back in 2011. I thought it was epically cool. Failed miserably. It was too early, right?
Yeah.
I thought the MP3 space was going to last forever, and that went up and down inside of 10 years. So there's a lot of ways.
Did you own a Zune? Did you have one?
I still have the box, and it in the box. Never took it out. So I think the question you ask yourself is why now? And usually companies will fail on that. They're too early or they're too late. And we have a heavy focus on product market fit. We have a method that discerns that, so we're getting better at that. We find that most of our startups fail for 3 reasons. Product market fit is probably number 1. You build a parking app and your cars know where your cars are now these days. Second is team, and probably the most important. The entrepreneur will pivot the company, and that's what we look for. And third is capital, and capital tends not to be our problem if we have good ideas. But that's what we see most fail on those 3 variables. But the why now, I've been too early a lot of times and too late a lot of times.
Nicole, similar question for you. Is there something that the organization has kind of thought, you know what, we should put a bunch of money in here, or we're really going to seriously consider it, and in the end you look back and go, nope, that didn't work?
Maybe I'll speak more to the approach that we probably missed on. I think given our direct investing history, where we've missed is when we forgot we don't know what we don't know, and we tried to go at it alone without leveraging the partners that we have globally. And so I think where we've evolved to now is we recognize, we like having a smart pair of hands at the table on sectors or technology that we don't understand. On the stuff that we do understand, then we'll go in, strong and on our own. But I think that was a good lesson for us because we were early investors in venture, and we had a larger but a very spray and pray approach at the time, and it didn't go well. And so now as we're rethinking kind of during this transition period, how are we going to do what we're going to do? It really will rely on having partners in place that understand the markets globally, but also specific technologies that we think are important.
Colin, on this kind of topic to a certain extent, you guys talk about sustainability. Years ago, to a certain extent, that was called clean tech. And I know it's not exactly what you do. It's not perfect apples to apples. But when you guys launched, you probably used that somewhere in marketing material somewhere. There was a lot of failure in that sector, not you guys per se, but in that general sector. What kind of lessons do you think folks who focus on sustainability took from what happened, say, where are we now, 8, 9 years ago?
Yeah, sure. Yeah, Generation's always talked about sustainable investing. Because we do a lot of stuff in public equity as well. So it's, look, I think, there was a lot of mistakes made in the kind of 06 to 08 period where people, uninitiated people were investing in something that thought was cool. So there was a bit of a kind of skill gap on one level, and that translated into a lot of essentially into the venture capital model being applied to a lot of areas of the kind of innovation landscape that were really kind of infrastructure kind of investments. So you had a mismatch between the fund structure and the opportunity set, and hence the kind of risk-return expectations. So I think there was plenty of fundamental kind of energy innovation investing going on from VCs that really should have been done by governments or large corporates.
I'm curious, was that similar to what Jeff said? I'm curious, was that a mistake, kind of a mistake that would have been a mistake today too, or to Jeff's point, was that being too early? So I think of Proterra, which you talked about, the electric bus company. A lot of the big clean tech, green tech, sustainability failures of 10 years ago was investing in, if not electric vehicles, but in kind of big manufacturing of product, and realize, what, we as VCs don't do this well, but Proterra is that now, right?
Yeah, a lot has changed. The technologies have got a lot cheaper, as I talked about. They perform much better. And it's interesting, a lot of the failures back then were kind of sort of B2B businesses, kind of industrial-focused businesses, whereas the success stories have been B2C businesses, right? So anything that is engaging the consumer on sustainability, funnily enough, the consumer wants sustainable products, be that in food or energy or mobility or whatever it is, right? So, I do think the fundamental landscape has changed a lot. I was thinking about kind of a technology that we thought was kind of interesting 10 years ago. We didn't place any bets, but it was just this sort of whole idea of biofuels, for example. That just kind of came and went, right? And a lot of people had a lot of great projections around biofuels, but they just basically went nowhere.
Is that, by the way, do you think that's a too early thing? If in 5 years, is there going to be a comeback of that?
I think there's probably a role somewhere in the landscape. I think it's very hard for everything to go electric, so there will be a role for alternative fuels at some, in a mix, basically.
Jason, is there something when you see your clients or potential clients of yours, is there from a call it futurist perspective or a tech bet perspective, is there something you've seen over and over the last year or two that you've just keep having to say, guys, no, don't do that. That is a bad thesis.
No, not really.
You have smarter clients. You have smarter clients. We have some time for questions if we have them. If not, I have more. So if you have one, raise a hand. For anybody up here, for everybody up here. In the front, there are runners, and he's actually running. No, now you started walking. You were running.
Fast walking.
That's better. Mild jog.
Miles to go before you sleep.
Serena Rosso is my name, from Australia. I'm involved in education, training and job creation. And our biggest challenge, of course, is education disruption and also transformation of jobs. So my question is to Schumacher. I mean, you've really impressed me. It could be your outfit. But how do we get a bit of you in that? I think one of the things that we're really struggling with is knowledge and wisdom. And, I've been in the game for 38 years, and I'm still struggling in how to lead this disruption space in my space. What do? Do we try something new by doing another Uber, and forget, the challenges that we have within our organisation? What would you do if you're in my position? Financially successful, but having still the passion to keep making a difference. Thank you.
It's a good question. I mean, in education, it's a thing, like we look at, we're a large VC, we've got 700 people because we both invent and invest, and we're global. We have a center there in Sydney, right in the rocks. It's right there. So, so you can come see us anytime then.
So you pay him rent? I'm confused. Continue.
Yes, and one of the things that we look at is it's not just about technology, but it's also about the human element. So we put a heck of a lot of push on human-centered design in what we do. And I think education has not been solved by technology. Apple tried to throw iPads in schools. It did nothing. LA, I think, is still suing them for that. And so it's not about technology. It's about the design. And then it's about the proper funding for those educational classrooms, which we just do not do. We're horrible here in the United States. You go to red states, and they have books from the 1970s. And so we have to figure out how we do it around design. We've done some tests where we taught 5-year-olds algebra. So it's possible. You can do this. So there's a lot of element there. There's been a number of startups that have been acquired by some of the people in this panel that I think are quite interesting. But I think it's more of a human-centered design element than a technology element. And I think when we approach it that way, I think we'll have better success. And education, as much as I'm a big proponent of democratizing technology, education is a fundamental element of that. And I think, but it's not a technology issue as much as it is, I think, a human-centered design issue that we have to go after.
Anybody else? I'm curious, we've gone 55 minutes or so, and I think I'm correct in saying the words AI and machine learning haven't been uttered, right, by anybody up here, which is, actually, it's fantastic. So let's break that.
You just mentioned them.
I did. I broke that.
That's really important to us.
So I guess, okay, so let me ask, I kind of a similar question I asked Jeff about blockchain to a certain extent, which is, what does AI mean to you right now? Because it's become this buzzword that seems to be applied to virtually everything.
Well, AI means using machines to recognize, understand, analyze, evaluate, and conclude decisions, help people make decisions and or make decisions on their own. And it also means machines that, having acquired all these characteristics, can write their own code to make the future decisions even better. So where does that come in terms of life? Or you can go to some crazy things like Minority Report or Terminator. But I think what it really means is helping us live our lives better, more productively, wasting less gasoline because we get the best route from Waze, wasting less time because we can get something at home from somebody that doesn't require a trip to a physical space so we have more time to spend with our kids or watch them play soccer or football or whatever. It means all those things. And I think it means every time you do a search on Google, it should be better and better because they keep getting more questions from more people on similar topics, and they can say, hey, wait a minute, people are really interested in the political result of this particular election. So how do we give them more information that's real, that's valid, so they can make a better decision? It's all these things, and I think the companies that invest in core AI software, in the physical infrastructure which facilitates that, one, have got a great opportunity, huge strategic advantage, and will be harder and harder to beat to the extent that anybody who competes with them doesn't have comparable capability.
It is supposed to get smarter, although my Uber app, it keeps getting dumber and dumber with times when my car's coming. Doesn't it? It's getting dumber. It doesn't make any sense.
If that software doesn't work, Lyft will figure it out. I mean, we're in a competitive economy, and everybody has access to the technology. It's what you do with it.
Nicole, are you, when it comes to AI, let me ask a broader question, which, we've been talking kind of a bit about portfolio construction. How about portfolio managers? Is your job a human job in 10, 15 years? Are you being phased out by a code?
I hope not.
But are you? I mean, do you think you are? And or let me rephrase.
No,
currently in your organization, are there roles that would have been at teachers a few years ago that don't exist anymore because you've got a computer doing it?
I think we're certainly opening our mind to and being proactive and bringing in individuals who understand AI in general, broad statement. We're certainly thinking about how AI, again, broad statement, is going to impact us as money managers or asset managers. We're thinking about how we can use data differently, how we can attract and retain talent that understands it. So AI is on our mind, but we don't think of it as kind of an isolated thing. It's just kind of a blanket theme that is either we're looking at it through our investing or risk or enablement lens that I referred to earlier.
Jason, similar kind of question to you, which is how is AI, particularly if at all, impacting the job you do and the job your group does?
So I'll give two questions. One is AI is an enabling technology, no different than the cloud, and it means virtually nothing right now. It means everything and nothing at the same time. Everyone talks about it. Every company is doing something, whether it's algorithmic, whether it's machine-based learning, et cetera, to impact their business. So to me, if you ignored the cloud as a premise-based business, your business would probably be suffering now or will suffer over time the same way if you ignored machine learning. At some point, it will disintermediate you if others use it effectively. As it relates to the question you asked Nicole, I think all of our jobs will get disintermediated by technology over time. The question is, will that be 5 years or 100 years? I don't know. My personal view is the less formulaic, the less prescriptive, the less that a job is formulaic, the more that you're going to have a length of time where your job will survive. What's happening right now? It's eliminating a lot of the process-based layers of what we did. For a long time, people did a lot of things that were rote, that were formulaic, that involved repetitive tasks. That's gone away. More and more of what we're doing is barbelling right now in terms of on the highest level of thought and then on the very kind of entry level. I think that's what's happening to our business, and I do believe at some point the jobs of investment banks as a firm, and frankly commercial banks, blockchain being one example, will get disintermediated, and the 8% of the GDP that goes to financial services will go down over time.
So don't teach your kids to be bankers, is what you're saying?
No different than my parents said, don't be a doctor.
Fair enough. Still doctors. Hey, thank you very much, our panel. Thank you all for being here. We are out of time.